Just about 10 minutes ago or so, we did get Uber's first quarterly results since becoming a publicly traded on the NYSE. Let's now bring in an analyst to discuss the results. Santosh Rao is joining us. He's the head of research at Manhattan Venture Partners. Santosh, good to be with you today. It looks like a pretty good quarter. What's your assessment?
Yeah, so it looks like they reported on the high end of the guidance, so which is always good. And the losses are still heavy. Revenues are growing slightly. I mean, sequentially was a modest 3% growth. But overall, I think it's all about the future. It's about how they manage their expenses. And let's see how, I think they are investing in Uber Eats, which they've said, and which was expected, which is good. It's a growing business. The ride-hailing business, the core ride-hailing business seems to have slowed down a little bit, according to their numbers on a relative basis. But overall, looks like that's where we are. It's still in the investment phase. As long as they can show that the losses can be controlled, they'll be okay. But at this point, there is no sign that it'll be controlled. They're still investing a lot.
Well, not only are they investing a lot, I mean, how do they, what is, and this was the question, of course, during the IPO roadshow, but what is the path to profitability? I mean, it's not just all investing. Some of the returns on the money that you're generating, the sales that you're generating, should on their own show some form of profitability.
Absolutely. At some point, there has to be some rationalization. So they just can't be spending money. Now that they're a public company, the pressure is even more. So I think what will happen is they need to improve the take rates, which means they have to manage the driver incentives and the rider incentives much better. They need to optimize that. They need to target it much better. So they need to control that. But on the expense side, also, they need to rationalize the expenses in terms of sales and marketing and in terms of, so there are things that need to be calibrated. And that's what they're working on, and that's the bet, and that's the only way to do it. There's no other way. And on the international side, there is competition also. In fact, a lot of competition. They need a lot of investments. It's a global play, but it's not necessarily, the US strength does not necessarily carry over into international, because everything is an incumbent. The incumbents in every international country are very strong. So it's going to require a lot of spending there as well. But right now, it's all about North America, and they need to focus on their expenses. So that's the only path: increase the take rates, reduce the expenses, and let's see if they can do that.
But Santosh, is it all about the US or North America? And the reason why I'm asking is because part of the differentiating story between Uber and Lyft was that Uber had the international exposure. But to your point, there are other players in their own domestic markets. And what's interesting about this report, Uber's report, Latin America's revenue dropped 13% on the back of more competition. So, I mean, how do you, as an analyst, talk to the company management and say, is this still the right strategy, and is it worth it?
Yeah, absolutely. I think that's been, and that's why we don't have, we recommend Lyft, and we are holders of Lyft as well over Uber, because we feel Lyft can manage their expenses much better. They're solely focused. It's a pure play North American play, and North America is where the ride-hailing business is. The revenue per ride is the highest in North America. So this is where it's at, and Uber and Lyft is pretty much focused here and in Canada. So I think that's where the thing. Uber is going to have, Didi is competing with them, Ola is competing with them. So they have intense competition across all over the world. So they need to manage that. It's not a given that they will succeed on the international side. It's all about here. So let's see how it plays out. That's why we believe that Lyft has a much better path to profitability than Uber on a relative basis.
On a relative, well, you know, in some ways it's all about relativity until it becomes absolute and people get tired of losing money.
Yes, absolutely. Now they will lose. I mean, they'll give them the benefit of doubt for probably a couple of quarters, make sure that the expenses are coming down, take rates are going up. But at that point, if they don't get it right, then there's, I don't know. I don't see how they can really come back into play.
So, Santosh, I guess one of the questions for investors looking at either Uber or Lyft is, what do you want to pay for these stocks? And at what price do you maybe get into the company? I'm just looking at a chart that I've got up over here with Lyft down 1.3% in the past 2 weeks. The reason why I'm asking is because when you take a look at Uber's results, they lost, call it $1 billion in the quarter, $1 billion. and they have revenue growth of 20%. There are small cap industrial companies or Russell 2000 companies that are growing at 20% that don't lose $1 billion on a quarterly basis. So put that into perspective for us in terms of whether or not you want to get into this ride sharing business. Obviously for you it's Lyft, but what are the apples to apples metrics that I just shared of Uber with Lyft?
Absolutely, yeah. So I think you really have to, it's not fair. In fairness to Uber and Lyft, you really can't compare them to the well-established industries of that are ongoing, that are out there. This is a transformational company. This is a transformational industry. You really have to bet on a future that's going to be different. It's going to be on-demand services. It's a huge market. For Lyft, it's a 1.2 trillion market opportunity. For Uber, on a global basis, it's close to 6 trillion. So they can, if they can get a small piece of that, that's good enough. So I think that's what you have to bet on. Is the transformation going to happen? And if it does, then these two players are the players that you bet on. So let's see if that plays out. We believe it is. It is possible. There is transformation. People want to rent. They don't want to buy anything. The millennials prefer this versus owning a car. People are not buying their second cars, things like that. So there is a gradual movement. It's going to take some more time. They're disrupting a very well-entrenched industry. I mean, owning a car and driving a car was a rite of passage for all of us growing up. So I think it's going to take a while to disrupt all that. So, and it'll happen. It takes some time. Maybe it's taking much longer, but that's the way it is. It's a disruptive thing, but it's a transformational story, and you have to believe in that.
So, Santosh, in terms of this on-demand transformation of our economy that we're talking about, who doesn't want everything delivered to their doorstep? Everybody would. I mean, it's convenience. But did they set the bar too low in terms of pricing? And the reason why I'm asking that is there a path to profitability to actually raise prices? And people are going to have to take it and like it, and maybe they will do it because, as you say, this is perhaps the new economy.
Yes, so the pricing today is not sustainable. They had to make the market, they had to create the market, and that's what they did. So now people they love the service. So you will see in our models, we have raised the prices going forward. They have to at some point, and it's going to be done rationally. I mean, even if you see the emails that come from Uber and Lyft now, it's very targeted. If you're very active, if you're not active, they give you incentives to come on, they give you all these deals. If you're very active, they know you're on the platform, so maybe the incentives are less. So now they're targeting much better. They have data right now from across the board. So I think they can target all the incentives much better. And second, the micro-mobility aspect of this is being underrated. You know, the electric scooters is going to be a big part of this whole equation. So in the ecosystem for the last mile. So they're investing heavily in that area. So you will see that will also add incrementally to the bottom line for these companies. So there are possibilities. Too early to write them off, but yes, it's a show me story at this point, and they need to prove it.
Last question here. Lyft is clearly your favorite stock in the ride-sharing business. What is your price target? It closed at $54 and change. What's your price target, and when do you see the company becoming profitable?
Yeah, I think our price target, even when we initiated, was about $62, about close to 21 billion. So right now, I think it's about 18 billion. They should have gone out in the 62 to 65 range. They went a little overboard, 72. The price that went up to 80 and all that. So there's a little bit of froth in IPOs. But I think in the 60 to mid 60s is a good price for them. And I think they'll get there. The profitability, according to our models, is about 2022, 2023. So it's about like 3 to 4 years away, but they will show a gradual improvement. They've already said that 2019 is the highest expense year. I mean, they're going to get all the maximum expenses in this year. So going forward, the expenses are going to go down and probably prices go up. So there will be a path to profitability.
Okay, Santosh, great to catch up with you today. Thank you very much.
Thank you. Thanks for having me.
That's Santosh Rao. He's the head of research at Manhattan Venture Partners.